Well, good morning, traders. Welcome to the weekly gold report. And I think it's a really interesting one this week because we are seeing gold finding its mojo. Last week, I came out with a fairly neutral stance on where it was going, looking at the multifaceted perspective of what was happening in the gold market. Today, you can't say that. Today, we are seeing a much more bullish structure. And I think gold needs to be traded from the long side or running a neutral strategy here, but certainly trading gold on the short side, regardless of the currency, seems at this stage to be quite a low probability strategy. So we have a bullish bias. We'd be looking to trade this along. The question is which currency would you be doing that in? Now, I think if you have set the scene and have a look at global markets more broadly, there hasn't been this big fallout just yet that says, oh, we've got to rush to gold. I think what you're seeing is a situation where you're seeing that US exceptionalism. People are saying, if I've got savings, if you're a big pension fund, can I go into LATAM assets? Can I go into various Asian assets? Probably not. The place that you're going to put that money is going to be into the US. So you're seeing strength in the US dollar. We're seeing that one-way move in the US dollar. You're seeing the equity market fairly well supported. Of course, liquidity continues to be a dynamic there, but you're hedging that equity exposure by being long US treasuries, and you're also hedging through being long gold. What does change that? What changes that US exceptionalism, that one-way flow into US assets? Well, you probably need to see better synchronized global growth. Clearly, that's not going to happen anytime soon. So it continues to be that we want to see a stronger US dollar. We're going to see bouts of profit taking, but we'd be looking to buy any kind of dips at the moment coming through. And there probably does seem to be a situation where at some stage too, the Fed are going to have to look at that dollar strength. And we'll talk about that in a minute. But at the moment, we take a bullish bias on what's happening in the gold price. And now if you have a look at other markets, the VIX, it hasn't really pushed above 15%, so implied vol in the S&P hasn't really broken out too much. We haven't really seen too much in the way of widening of high yield spreads relative to risk-free rates. Even if you go into investment grade and go to the triple B tranche, you can't see that having moved too mildly. So the case for complete risk aversion hasn't really kicked into markets at the moment, although we are seeing signs that people are using gold as a hedge against some of the portfolio dynamics that are playing through. So have a look at the daily chart of gold in US dollar terms. You can see we've broken through that triangle. We've made a closing high, the highest level since 2013. We're just trying to look to see if we can take out that spike that we got back in early January, around 16.11 in US dollars. So this argues for a continuation. We want to probably see a bit of a pullback to see if we can test that breakout level, whether that now becomes support. But at the moment, given what we've been seeing, we've seen a range break, which you can see with those sort of dotted red lines. You can see that we've broken out this triangle. It does argue that any kind of pullbacks here, if we do get confirmation of that support now, or that resistance becoming support, that would be a very bullish situation, and we buy the higher high. But at the moment, that technically looks quite good. I talked about what's happening in the gold market being in dollar terms, but the fact is that when you adjust that into currencies such as Euro and Aussie, which we can see from this chart here, we can see that making record highs. I love to see gold making new highs in other currencies, and what we've seen over the last 5 days, even the strongest currency in major currencies being the pound, we can see the gold price up, about 1.8%. In British pound terms. So the gold price is rallying pretty strongly in every currency terms. Is gold being used as a currency in its own right? I'm not so sure about that just yet. The dollar's still got its attractions, even though dollar in the last 5 days, gold in US dollar terms is up about 2% or so. In the weakest currency, which we're looking at something like a euro, we can see gold up nearly 3.5% or so. So, you are seeing gold moving up in every G10 and major currency at the moment. That's usually quite a very positive situation for gold price. And as we can see here in this trend that we're seeing in gold in Aussie dollar terms and euro terms is very strong. Now, people have been saying to me, Chris, that the euros are very, very oversold. Yeah, that may be the case, but at this junction, there's no real reason to be buying euros with any conviction other than just to take profits. What we're seeing is that the data has been very weak in Europe. You saw the ZEW survey last night, both in Germany and Europe, coming out very much on the weak side. We'll go into the calendar in a second, but you can see that people have been using euros as a funder for carry, and we've also seen that deterioration playing through in the European economy. Aussie dollar gold is a bit different because on Thursday, tomorrow, we do get the jobs numbers there. We know the minutes were a little bit more sort of dovish at the margin, but if those job numbers come out topside and they come out strong, we get that unemployment rate, heaven forbid we come down to 5% or so, then you are going to see the Aussie have a bit of a rally. Gold in Aussie dollar terms would probably struggle. So if you are running long positions in gold in Aussie dollar terms, do consider that tomorrow we do get this event risk. Obviously, if we do get the unemployment number in Australia coming out at 5.3%, then Aussie dollars are going to continue on their merry sort of descent lower. And that's something that we're going to be looking at very closely as well. Now, I think obviously we're looking at what's happening in the coronavirus, and we're hedging ourselves using US Treasuries. We're hedging ourselves using gold. The idea that Apple have come out and shown that the corporate landscape, the world's biggest company, is really getting affected by the slowdown, both on a supply chain side of things, but also in a demand from China. People extrapolating, well, if it's going to happen to Apple, clearly it's going to happen to other companies, computer companies, apparel companies. And ultimately, what is the extent of the slowdown going to be? Let's have a look at the chart of how the 10-year real yield is influencing the gold price. And you can see that the 10-year real yield is going lower, and you can see we're sort of sitting negative 10 basis points at the moment. So what I've done is I've used the 10-year Treasury bond, the US Treasury bond, and I've just inflation adjusted that to get what we call a real return, or the real yield. That's sitting at negative 10 basis points. I've actually got the gold price. I've flipped that upside down to show the relationship. So while gold is actually going up, yields are going down in that scenario. So if real yields are going to make a new low in this run, that's only going to incentivize gold buying. So you can see that correlation has picked up over the last couple of days, and you can see that there's a strong relationship there as well. So once again, we do need to continue to take a view on what's happening in the bond market. Equities may be near all-time highs, but the Treasury market's telling us a fairly powerful message there. If we can see this fallout from the economic data and disinflationary pressures start to really kick in, then gold prices are going to work very well, because what we're seeing is that strong correlation between the real yield market there and gold prices as well. So we continue to watch that very closely. Now, what I'm looking for in terms of fundamental catalysts for the gold price, if those yields are going to go down, what's going to cause that to move? We'll have a look at the dates for the diary here. Upcoming on Friday, we've got Korean 20-day exports. Now, what I'm specifically looking at is data that's going to be affected, or could really be affected, by the slowdown in China. The ring fencing, the quarantine, the unprecedented measures that the Chinese authorities have put in place. How is that going to affect demand, both domestically but also externally? People, trading companies and countries which have very strong relationships and ties with China. Therefore, I'm looking very closely at the February data flow, which should get affected by these numbers. We're looking on Friday at Korean 20-day exports. We're looking at the consumer confidence numbers. That doesn't come out to the 25th. On that same day, though, if you go right to the bottom of the chart, you can see that we're going to get German and Eurozone PMI data. Now, I expect those numbers to be pretty weak. Certainly if you look at the the German PMI numbers, they're already in contraction. They're sitting around sort of 45 on that diffusion index. There's a pretty good chance that's going to deteriorate more. Now, the market's looking for that to come out slightly weaker at 44 on that diffusion index. We expect, if that number comes out, say 42, 41, or even below, the euro continues on its merry move down. We're going to see bond yields moving lower. We're going to see that euro priced in gold continue to working very well. That's going to be key as we go into the weekend. Now, going to what's happening in China next week, we get on Saturday the manufacturing and services PMI. That is absolutely key now for the gold price. We're going to go into that weekend knowing that people are going to be looking very closely, not just for manufacturing, but also the service side of things in China. The idea that we could be potentially getting a contraction in Chinese services, and that will become more of an influence on markets. On Monday, we get on the 2nd of March, we get the Taishan China PMI numbers. The service numbers come out a couple of days after that. But that's going to be really key. We also get the import-export data on the 7th of March. And the biggie for me, as well as the China numbers, is on the 3rd of March, you get the US ISM manufacturing numbers. We get Taiwan numbers coming from the 3rd of March and 9th of March. But these are the dates for your diary. I know they don't happen necessarily all at once. They're going to come over the next couple of weeks. But if we want to see the extent of that slowdown and what it actually means, when we start actually getting the real fact, that's when people are going to say, have we priced in too much? Have we not priced in enough? And that's what gold's going to be really sensitive to. So I've specifically looked at influences around that. Now have a look at what we're seeing in terms of the reaction in markets, which I think is really key for front-end yields as well as what we're expecting. So I've looked at the interest rate expectations in the market. If you look at that second column, you can see what's priced in for the upcoming meeting. we started to get a little bit excited about the prospect of rate cuts coming through from central banks. We haven't seen much of a move coming through in equity markets, I say, but we have seen those bond yields moving lower. We've started seeing a flattening of curve. We've seen the gold price respond. We're now seeing the Canadian central bank about a 1 in 4 chance that they could move on March 4th. Have a look at the Bank of Japan. There's a 1 in 4 chance there as well. RBA, very low in terms of what we're seeing in March. But go out further out the curve. Go out to the June meetings and the May meetings that we're seeing there. So that we're starting to price in a 50-50 chance for the April meeting in Canada and also the June meeting there. We start pricing in the Fed having a 1 in 3 chance of that April meeting. But if we do start seeing a tightening of financial conditions, if those bond yields start moving a bit lower, and we do start seeing inflation expectations starting to fall, then that April meeting for the Fed's going to ramp up. Now go to the right column, you can see what's being priced in over the coming 12 months. It's the Fed that is expected to be the most aggressive. The market's pricing in 43 basis points. I still think that's about fair. I think there's possibility we could get that to about 50, maybe 75 basis points. I know there's some investment banks who are looking for 3 rate cuts. But let's have a look at, for me, what is the most important chart, which probably hasn't got huge amounts of airtime at the moment. And that's what's happening with the dollar. As I talked about there, the US economy and the US sort of investable markets, investment markets are the least dirty t-shirt. They are the best house in a deteriorating neighbourhood, shall we say. We don't want to be in Europe. We don't necessarily want to be in the UK too much. We don't really want to be in parts of Asia. LATAM markets are probably not liquid enough for those savings. So therefore, we go into the US. We continue to buy those markets. The dollar is benefiting. If you have a look at the top pane, you can see the dollar index. You can see the trade-weighted US dollar. And these are coming out to the highest level since 2017. That dollar is one-way traffic at the moment. There's very few currencies which look really as attractive as the dollar, maybe the yen to an extent, and certain LATAM countries like Mexican peso has been doing quite well. But against the major currencies, it's really the dollar which is sort of dominating at the moment. Now have a look at the bottom pane. You can see 5-year break-evens. To put this in layman's terms, these are 5-year expectations of inflation starting in 5 years' time. Now we know the Fed look at this very closely. We can see that started to roll over a bit. We can see it's sort of tapering into the sort of this low congestion area around 1.65%, currently sitting at 1.7%. If we do see that dollar kick up, now that relationship between the dollar is starting to build with inflation expectations. We are starting to see the market looking more aggressively at what the dollar's doing to inflation expectations. If that continues to be in earnest, there is going to be a point when those inflation expectations start moving lower. Now, if you go back to 2018, we saw that big drop of about 50 basis points or so in inflation expectations. That was the trigger, in my opinion, for the Federal Reserve to come out and do this big pivot. So what we're looking for is if we do see those inflation expectations start to meander lower, then you are going to see a bigger reaction from the Federal Reserve. You're going to see other central banks moving to a more dovish stance, and the gold price is going to benefit from that as well. So the dollar, if it goes higher, that's when we're going to see inflation expectations sort of test this support zone, this congestion zone around 165. If they break there, we're going to see a significant impact from central banks. That's why I think the gold price in dollar terms continues to work quite well, and gold's probably going to start trading more as a currency in its own right. You start talking about currency wars more aggressively. What's Trump going to say? When's he next going to come out on Twitter, talk down the currency? But the Fed, not necessarily going the same way as Trump, will look more closely at what's happening in inflation expectations and the impact that the dollar has on inflation there as well. Have a look at positioning. You can see the weekly commitment of traders report here. Now, for those eagle-eyed people who pointed out last week that I had the wrong numbers, I have made sure that I've actually got the right numbers here today. So we've got 196,000 net long contracts on gold. We're looking at both options and we're both looking at futures here. So this is total managed money positioning. You can see we're sitting at 196,000 net long contracts. That's one standard deviation, which you can see from the green line, above the sort of 5-year average, which is the blue line on that top pane there. That tells you the 5-year average. So we are at somewhat stretch levels, but we're not at levels where I'd say, too many people have bought. There's no new money to come back in. We've seen a bit of a build up in gross longs. Shorts have sort of cut back a touch, but they're not really going too much. But yeah, 196,000. So we're one standard deviation above the 5-year average, which has been a level where we sort of capped out, but we're not at levels where we're really too concerned at this stage at the moment. In the options market, we're looking at the bottom pane here, where we're looking at 25 delta risk reversal. So this is 1 month options. So we're looking at the skew effectively of 1 month call volatility minus 1 month put volatility. And this really gives us a sense of what people have been doing in terms of buying up that optionality for bullish structures relative to bearish structures over that 1 month expiry. And you can see that the premium of 1 month call volatility sits at 2.23 vols over puts. That's not overly stretched at the moment. If you said to me we're trading 4 volatilities in calls over puts, I'd say we're at extremities, but we're not. We're 1 standard deviation above that 5-year average, so we're not at levels where I'll be too concerned. I love looking at risk reversals. They tell me a lot about semantics. Are we at that kind of euphoric stage for gold? We're not. We're sort of getting there, but we're pushing up, and that tells you the market's bullish, but we're not overly concerned at the moment. I've also looked at front-end vols, 1 month implied volatility in gold relative to longer-term volatility. We can see that in the top pane. I've looked at 1 month minus 1 year. That vol has moved up a little bit in terms of short-term vol. Usually a sign that people see a more aggressive move in the short term, but it hasn't really got to levels where I'll be overly concerned at the moment. We're still not even at the mean of the 5-year average. So the options market's telling me that despite this breakout that we've seen in US dollar gold and multi-currency gold, we're not at kind of euphoric levels at the moment. And if you have a look at the GLD, which is the gold ETF, you can see the cumulative fund flow, the money flow there. You can see in that sort of middle pane, has been moving up. That's obviously very positive, but the actual estimated money flow in the second from top pane hasn't been overly inspired. Now that tells me that despite this big move that we've been seeing in gold, it hasn't necessarily been that we're at this kind of stretch level. Gold is not overloved, it's not over-owned, and therefore it sort of just plays into my view at the moment that everything I'm seeing in the gold price and the gold market remains fairly bullish. So keep your eye on that calendar. If those data starts to really show us evidence that the China, what's happening in coronavirus and the authorities slow down, is impacting that data more aggressively, then the gold price is only going to go one way, in my opinion. The question is, which currency do you buy it in?